Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss the Canadian retirement tax trap. Specifically, I'm going to chat about a potential conflict of interest many people don't realize, timeless advice from my mentor, optimizing the tax valley so you can spend, gift, or donate more, our step-by-step year-end tax planning process, the importance of a unified approach, and lastly, as always, a few action items for you to consider. Whenever we meet with prospective clients, I'm always shocked how little tangible advice they receive to help minimize their taxes, add flexibility, and enhance long-term outcomes. I think most Canadians may simply get complacent with their existing advisor relationship. Their investment person handles the money, and that works for a time. But when a life event happens or one nears retirement, the gaps in investment-only advice really start to rear their head. Now, there could be a number of reasons for this. Perhaps this is the advice model you have chosen. You want a portfolio manager or investment guy that just looks at the numbers, plays around with stocks and maybe a few ETFs, and tries to make the right guess. As someone in this industry, the quote-unquote sexiness or appeal to this kind of investing has always baffled me. In my opinion, investing for most Canadians, even as their wealth stretches into the multi-millions, has been pretty well solved by boring, time-tested strategies. But perhaps that is a conversation for another day. Others simply don't know what they don't know. This industry has countless designations, titles, and qualifications that make it nearly impossible to sort through advisors without actually experiencing how they help clients. One other reason you may not receive tax planning advice may also be due to a potential conflict of interest some advisors and wealth management firms may have. Without getting into the weeds too much, many wealth management firms operate and charge fees in a fee-based account. To you, the client, this typically shows itself as a percentage based on the assets you have under management that typically goes down as your assets with the firm increase. With this kind of model, suggesting someone tax plan and perhaps draw additional funds out of certain accounts, or to encourage someone to gift money during their lifetime, is a direct headwind against that firm or advisor's revenue. Now, I'm not suggesting this is practiced anywhere, only expressing that this could be a potential conflict of interest. Now, to be upfront, we operate a fee-based practice. So when we provide suggestions and advice that are in the best interest for the client and happen to decrease our revenue, we don't hesitate. We don't have targets or quotas. We have our client's best interest at heart. My former business partner and mentor, Richard Kilburn, gave me sage advice that he received from his father, Peter Kilburn. Take care of your clients, and they will take care of you. At the end of the day, we are paid well to steward our clients' personal finances, and we treat this responsibility with the utmost respect and seriousness. If it needs to be done to put our families in a better position, it gets done. One of the most impactful planning strategies we work through with our clients, and where we tend to provide the highest level of value, is through our tax planning. This is an integrated approach that factors in all sources of income, taxable accounts, real estate assets, pensions, and more into a unified strategy to mitigate lifetime tax, create predictable after tax income, and help guide our clients into spending with confidence. One part of this overall tax planning process is to help mitigate the tax trap that exists with RRSP and RRIF accounts. Now, as you're probably already aware, RRSP account withdrawals are 100% taxable as income. And while you are under the age of 71, you can defer these tax consequences into the future. And then at 71, you are forced by the government to convert your RRSP accounts into RRIFs. At this point, there are now required minimum withdrawals that are calculated based on your age and the account value at the beginning of the year. So, as an example, if you turn 72 the year after converting your $1 million RRSP to a RRIF, by the end of that calendar year, you would be required by law to withdraw 5.28% or $52,800 of taxable income from your RRIF. Assuming you're receiving CPP, OAS, some taxable investment income, and perhaps other sources of income, all of a sudden you may find yourself in a situation where you have substantially jumped tax brackets and have lost control of your ability to control tax. If you're an investor who focuses their non-registered investments in Canadian dividend-paying stocks, you are most certainly driving up your marginal tax rate even further on other sources of income. In episode 71 of the podcast, I did a bit more of a deep dive on the impacts of dividends to retirees' income and taxes. So I highly suggest you give it a listen if you haven't done so already. Now, for many Canadians, when we start to stack all of these incomes on top of a RRIF income, there is also a strong likelihood that they may lose some or all of their OAS benefit to the OAS clawback. This is an effective 15% increase to every taxable dollar you earn over the threshold, which is currently around $95,000 for the 2026 tax year. Furthermore, if you live in a province that has a seniors drug plan that is income tested, chances are you may also lose this benefit. In Saskatchewan, for example, there is a seniors drug plan, and if your income is above approximately $80,000, you would be disqualified from the $25 cap on prescription drugs listed on the Saskatchewan formulary. For those out there who don't have coverage and utilize drugs that would be vastly more expensive otherwise, this could be a devastating loss. So what can you do about it? Well, if you're retired, whether you're 55 or 65, you can consider drawing taxable amounts directly out of your RRSP. If you are 65 or older, you will actually want to do a partial RRIF conversion rather than an RRSP withdrawal. This is because at 65, you can now split that income with a spouse and you can deduct the pension income amount, which could save you another $300 in tax if done this way. It's also important to note that it should likely only be a partial conversion, as we want to control the amount of taxable income flowing out, and not be hamstrung by a RRIF minimum that causes us to lose control. Now, the goal here is to draw out money gradually out of the RRSP or RRIF in a controlled manner to avoid a potential tax trap at age 71 or at death. This needs to be done in concert with a full understanding of other taxable incomes, like pensions and non-registered distributions, or perhaps one-off taxable events like the sale of a rental property that triggers a capital gain. It really isn't a set it and forget it thing. It needs to be reviewed and optimized each and every year for changes in your circumstance. I think one of the key understandings here is that we're not doing this kind of planning for month-to-month spending. In reality, it is a tax move to create flexibility and smooth taxation over the long run. And if planned for properly during the time I refer to as the tax valley, when you retire to age 71, it can drastically impact your lifetime tax bill, mitigate or eliminate OAS clawbacks in the future, and potentially result in higher fixed CPP or OAS pensions if they are delayed deliberately. So, as I mentioned, for most clients, this isn't something we do for month-to-month income needs, rather to optimize tax brackets. One such tactic would be to take the after-tax proceeds and use them to top up the tax-free savings account, the TFSA. Others may consider this kind of tax planning at year-end as a part of their year-end giving or donation strategy. If your overall retirement sustainability is in good health, your options with what to do with this now tax-paid monies are endless. For many of our clients, we complete this tax planning at year-end and then use the proceeds to top up their tax-free savings account the first week of January or so, with additional balances being invested in tax-preferred investments in the non-registered account or a part of their year-end giving strategy. So, what does this look like in practice? In our firm, we analyze and estimate our clients' income sources, deductions, credits, and one-off taxable events for that calendar year. We always do this at the end of the year, typically between October and November, for a few reasons. First is that we have now nearly a full year of income to review and analyze. Second, it allows us to consider triggering capital gains in certain accounts, and this helps us to ensure that investments remain suitable and that investments haven't become overconcentrated during a bull market. And lastly, if we're triggering tax by withdrawing funds from an RRSP or RRIF, we are required to remit tax to the government, and we want to wait until the last few weeks of the year to give them their pound of flesh. That way, your money stays working for you longer, and the CRA gets their money at the last minute. So, in summary, here is how it goes at a high level. First, we add up all of your expected incomes. Second, we review the marginal tax brackets in your province and determine what upper limit of the tax bracket schedule we want to utilize. Third, we determine the gap between your expected income and our desired tax bracket. And four, we complete a gross withdrawal to fill that gap and optimize your tax bracket. Now, this is not a one-size-fits-all solution by no means. And for some of you, it may actually make sense to defer your RRSP to later years. This kind of planning is robust, multifaceted, and ever-changing. If you're curious what this kind of thing might look like for you, I encourage you to discover our fundamental retirement plan process. There's a link in the description if you want to get started today. So why do we do all this? At the end of the day, this kind of planning is about creating predictability and control. It gives the control now to smooth taxes and avoid tax bracket spikes or clawbacks in the future. It frees up tax-paid dollars today and gives you the flexibility to spend, gift, or donate without the fear of taxes looming in the future. It's about intentionally building a sustainable, predictable after-tax income that is in your control, not the government's. And above all, it gives you confidence that you can retire and stay retired, regardless of what life puts in front of you. Okay, so that'll do it for today. Here are your action items for today's episode. First off, have a look at your most recent tax return and then Google the combined provincial and federal tax brackets for your location. How close are you to optimizing that tax bracket? Are there opportunities to free up tax-paid dollars and roll them into your TFSA in the future? Next, while you have the tax return open, look at line 12,000, amount of eligible dividends. If the number you see in this box is significant, you may be inadvertently driving up your marginal tax rate and triggering an OAS clawback if you're currently receiving OAS. Lastly, review your non-registered account not only for these dividend-heavy investments, but also for positions that have grown substantially over the last few years and now have a substantial gain attached. You may consider triggering gains to bring your portfolio in line while optimizing your tax brackets. Okay, so that'll do it for today's episode. Make sure you add us on all of our socials, LinkedIn and Facebook. Check out the links in the description for that fundamental retirement plan if you're interested in checking out our process. If you've been listening to the show for a while and you're really enjoying it, please leave us a 5-star review in your favorite podcast app. It helps us out a ton. Make sure that you're signed up for our weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.